Apple is trading at $129 per share right now. However, it is down 28% so far over the past year. Now, before you start getting all sad and stuff, remember, Apple's a $2.07 trillion company. And if you compare to other stocks like Amazon or like Meta, aka Facebook, each down over 50% for the past year, you know what? Apple might be looking kind of good. But of course, we're not going to be guessing in this video. I'm actually going to do a valuation and show you my actual personal price target for this company so you know what I think it's actually worth. But the first thing we need to do is we need to show you something visually. I think it's amazing. You see, when people start investing, and maybe you're a little bit newer, maybe you're still learning, maybe you're not an accountant, and maybe you don't know how to read financial statements. This is Apple's 10K filing. I mean, it's giant, right? And not a lot of people are going to go through and read this entire thing. You're probably still learning, right? So how about I show you a visual way to look at this? We're looking at Apple's consolidated statement of operations, and I'm about to reveal to you what I think is probably the best thing you're ever going to see if you're trying to figure out, wrap your head around investing. So here is an income visualization of what I just showed you. What this does is it takes everything from the net sales. If we go back and I'll show you what the net sales is, you can see net sales here, total net sales here, $394 billion in net sales. Well, look what we have here. 394 billion of net sales. This giant bar here is showing you that the largest portion of this entire statement is this big bar, which is net sales, 394 billion, and it's up 8% year over year. Right now, I think hopefully you can see visually, this is going to tell you a lot more than just looking at an income statement before. What we can actually do is we could trace the green path over here to get to net income or earnings. $100 billion, which is over here. Net income. This is it. It's rounded up. Okay, 99 billion, $100 billion. This is the earnings. This is the net income of Apple. How do we get to that net income number? Well, over here we have the iPhone. 205 billion in sales for the iPhone. It's up 7% year over year. Now we know how big a portion the iPhone is of the net sales of this company. It's very big, right? Look how big this little bar is here. And it's up 7% year over year. So we know it's growing. Mac is up 14% year over year. It's doing better than the iPhone is doing. It's 40 billion. It's a smaller portion of revenue. iPad is actually down. They're losing money on iPad, or not losing, but the growth has gone down in iPad. 29 billion instead of what it was before, which was higher last year. Wearables, home, accessories. This is up 31% year over year. This thing's growing really well. However, it's only 1.2 billion of the revenue. So it's a much smaller part of the revenue. It's a very tiny, minuscule part of Apple's revenue. However, it is growing. And then we have services up 31%, also growing very well, 1.2 billion of revenue. And by the way, services are going to be things like iCloud, iTunes, things like that. So if you're paying for a service for Apple, it's going to go in here. Now, okay, let's go over here. So net sales, how do we get down to this net income? Well, first off, we have net sales minus the cost of the sales, 224 billion, gets us the gross margin. Then we take gross margin, we subtract from operating expenses. Income before taxes is what we get once we subtract these two. Well, now we're at 10% up for the year, so a little less than the operating expenses were growing. And we have net income. What we did here is we had to subtract the provision for income taxes, which actually was up quite a bit, up 27% year over year. But we still, at the end of the day, we get a 5% increase in net income for Apple. I mean, who wouldn't like this income visualization? Actually, that's really a question. Like, do you like this income visualization? Because it takes a lot of time for me to make this. And I need you to let me know in the comments if you actually like it. Because if you do, I'll make more. And if you don't, I'm not wasting my time doing this anymore. We have a good idea now about how Apple makes money, how they get to their net income, their earnings, right? Next up, we want to see how they compare to other companies. After this, I'm going to show you my price target. So what we have here are comps or comparables. We're going to actually compare Apple to other companies inside the sector or the industry, actually, not the sector. 21 times earnings, let's say, and then the average of the industry is 71. So Apple's got a much lower PE ratio, which is good. Then you have the median industry at 20.66. So it's closer to the median, which is good. Now the decile, we want the decile to be as high as possible. Maybe 1, 2, 3, or 4 is kind of like what I like to be as a sweet spot. It's in the 6th decile. So it might be a little expensive in terms of the multiple you're paying to get to this company. Not necessarily, but it's just a little higher on the decile. We have the PE, the forward PE. It's in the 9th decile. Not so good. So maybe it's a little expensive in terms of the forward PE of Apple. And then we have the price to sales, 5.23. It's in the 10th decile. So again, maybe it's a little expensive in terms of sales. The price to sales ratio, price to free cash flow, 21. It's in the 4th decile. Okay, pretty decent, right? It's in the middle there. As we move down more and we see the gross margin, this is where we kind of understand, well, maybe people are actually paying more money for Apple because they have such good margins. For example, 43% gross margin for the company. It's in the 2nd decile. It's one of the best margin companies that you can get in terms of gross margin and profit margin, 25%. It's in the number 1 decile. So it's in the top 1/10 of all the companies in terms of its profit margin. So it's very good profit margin. Then we take a look at the growth, and this might also be a reason why Apple could potentially be worth more than its peers in terms of the multiples people are paying. Okay, we have sales growth over the past 5 years, 11.5%. It's in the 3rd decile. That's good. We have earnings per share growth over the past 5 years, 21%, the 2nd decile. So very high in terms of decile. In terms of the earnings per share growth over the past 5 years, that's equity ratio, 2.37. It's a bit higher than its peers, but I think Apple has ample cash flow to probably pay down its debts. Not too worried about this one. Okay, those are the comps. That's how Apple does versus its peers inside its industry. Now let's talk about valuation. I'm going to go over 3 different valuation methodologies. I'm going to weight those 3, and then I'm going to come up with an average. That's going to be our price target. First here, we're going to go over EV to EBITDA. We're going to do a valuation using that method. I'm going to also do a discount earnings per share. I'm going to do a discounted free cash flow. We're going to come up with a price target for this company. I'm going through this fast, but I know for those of you who are trying to learn, I did include the formulas, kind of what we're looking at here. But step 1 is I'm forecasting the shares outstanding. This is the decrease in shares over the past certain amount of years, and this is what I'm using, 3%. It's the shares. I'm doing an EBITDA forecast next. So what I do here is I just take, these are the past EBITDAs that have been over the past few different time periods. I'm taking this 98766 percent is my EBITDA growth forecast. This is how much I get for EBITDA per share after I do that. Next, I take a historic EV to EBITDA multiple. These are different multiples over the past few different years. 12.25 being the lowest, the highest being about 24.53. It's a pretty big range here. And so what I do here is that pick a multiple. So if I pick a 12, Apple's then worth $104 right now, and it's actually not worth as much as it is. So it's essentially, it's worth less than it's trading for right now. That's how this whole thing works. So what I'm doing is I'm saying, what multiple am I comfortable with given the different multiples that we have up here? I'm going with a 16 multiple, so kind of in the middle of what it's been over the past few different time periods. So that gives me a 7% upside. It's worth $139 in 2027. I have it growing to a compound annual growth rate if I bought this and I held it until then, 9.5%. Next up, we're going to go with a discounted cash flow and discounted earnings per share. So here we have a DCF, discounted cash flow. I'm using Guru Focus for this. This is just a calculator you can use. Pretty simple stuff. So here we have free cash flow, and free cash flow is at 14.20% over the past 10 years. That's the growth of free cash flow. I'm using a 13% growth rate for free cash flow, and then I have a fair value of $145 per share. There's a margin of safety of 10.71%. You can see that the stock price is actually a little undervalued compared to the fair value that I just got for the company. Okay, let's talk about earnings. The growth in earnings is similar to free cash flow in a way. So we have 14.90%, 10 years, 5 years, 21%, 1 year, 8.90%. I basically ended up going with 13%, same thing that I used for the free cash flow. This actually gives us a little lower of a price target. So it's actually fair valued if we use this methodology. It gives us $130 per share, and the current stock price is $129. So fair valued stock. What I do is I just add these all up and I weight them. So we got discounted free cash flow. I weight this higher because cash flow is probably the most important. I use 50% of the weighting here. $145 price target is what I got before. Discount earnings per share, remember, 25% is this one. $130 the price target. EV to EBITDA valuation, 25% of the model. $139 is what I got before. That gives us a $40 price target. It's upside for this year of 7.56%. So I buy this stock. Well, let me tell you in a second. First, let's take a look at the chart. This is the chart of Apple going back to 2019 in January. We're just doing some simple stuff here, some trend lines, some support and resistance. So let's zoom in for a sec. If this is the downtrend line, we could see that there's a 33% potential upside if suddenly it shot up to here. Now look how quickly it did shoot up before. So it actually potentially could kind of happen. Probably not this quickly. Might be over here a little bit, but let's say in the 30% region if it suddenly shot up. And that would be until it hits this resistance area. Well, the other potential is, okay, let's say it just falls down to the 7% area here. This is where we have some support, and maybe it actually breaks down through that support and we get down to about down 18% here. It's another pretty major support in my opinion. So, you know, this thing could go down further, another 18%. Take a look at the stock price. That actually puts us at about $106 per share. Does Apple have more potential to go up or down in the short term? Let's take a look at the indicators. So here we have RSI. RSI is very close to oversold. So that's actually a good thing. It means that maybe the potential of the stock to continue going down, the momentum maybe is going to stall. We also have a little something called a divergence here. So basically RSI is showing that it's continuing to have lower lows, but when you take a look at the stock price, it does also show the same as the RSI indicator, lower lows. But when you take a look at the MACD, it's actually got higher lows. So that's actually not that bad. That's an example example of a divergence, which could be a good sign for the potential price movement of the stock. So at $129 per share, would I buy Apple right now? I would actually wait until it got down to the between 110 and 120 area before I was kind of interested in purchasing the stock. But the question is, you want to supplement buying an individual stock more with like a broad-based approach? And if you do, you're probably going to want to watch this video right here. And by the way, disclaimer right here, and I will see you next time.